Namaskar dosto. Welcome back to the Stock Info. Today we are going to discuss an important subject in our episode 28. ROCE, the single metric that separates great business from average ones. Return on capital employed. Why Infosys generates thousands of crores using almost zero physical capital. In our section 1, we'll discuss a genuine intellectual excitement. This is one of the most surprising facts in the corporate finance. Tomorrow is July 23rd. Infosys announces Q1 FY27 results. The company is expected to report revenue of approximately 42,000 crores. Profit is approximately 8,000 crores. Now, here is the fact that should stop you in your tracks. To generate 42,000 crores of revenue, Infosys needs almost zero capital, no factories, no raw materials, and no heavy machinery, just laptop software and human talent. Compare that to a steel company or a power company or an auto manufacturer. Rupees 42,000 crores of revenue requires thousands of crores of physical assets for those business. There is one metric that captures the structural advantage. This is called return on capital employed. Yes, ROCE. And understanding ROCE will change you how you evaluate every single business in your portfolio. This is episode number 28. Now, what is an ROCE? The formula and its logic. Build the formula carefully. This is the most important definition in the episode. Return on capital employed equals EBIT divided by capital employed multiplied by 100. EBIT is earning before taxes, interest and taxes, the operating profit before you pay lenders or the government. Capital employed, the total assets minus current liabilities. The capital that investors and the lenders are permanently committed to the business. The formula answers one question. For every rupees 100 of the capital that investors have put into the business, how much operating profit does it generate? Yes, if ROCE is 40%, rupees 100 of the capital generates rupees 40 of the operating profit every year. If ROCE is 8%, rupees 100 capital generates only 8 rupees. Now here is the critical comparison. The cost of the capital in India, what investors require to justify putting money in equity, is approximately 10 to 12%. Any business you take earning of ROCE about 12% is creating a value for its shareholders. Any business earning ROCE below 12%, even if it shows positive accounting profit, is destroying value. The profit exists, but it does not compensate for the capital risk taken. Now, coming up, why ROCE is better than the ROE for comparing business. The three returns metric that when to use each one. ROCE versus ROE and ROA, which one to use and when. The most analytically sophisticated section, three metrics clarified here. The most investors know ROE, return on equity, from short 49. Some know ROA, that is return on assets, and some knows ROCE. Is that different from both and more comprehensive for most businesses? Here is the critical difference. ROE equals to net profit divided by shareholders' equity. It only looks at the equity capital. A company that borrows heavily and invests even at the mediocre returns can show a high ROE due to financial leverage. ROCE equals EBIT divided by capital employed, which includes both equity and debt. It strips out the leverage effect completely. ROCE is pure business quality metric. If ROCE is high, underlying business model generates exceptional returns regardless of how it is financed. And if ROCE is low but ROE is high, the company is using debt to amplify mediocre business returns. This is why Warren Buffett and Charlie Munger focus on ROCE, especially the business that earns very high ROCE on the full capital without needing to take an excessive debt. Infosys ROCE is 35 to 45%. Virtually zero debt is generally exceptional. HUL ROCE is 100%. Again, minimal debt is extraordinary. ROA, return on asset, is the most conservative measure. Net profit divided by total assets. Use ROE for comparing high asset intensive industries like utilities or banks. Now use ROE for comparing with the banking sector as F short 49. Use ROCE for comparing the quality of a non-banking and financial businesses. Now in the section 4, high versus low ROCE sectors, Infosys versus NTPC versus Hindustan Unilever. Use the live Infosys data as the anchor throughout this section. Let me walk you through the complete ROCE spectrum for the Indian companies. At the top, Capital Right IT Services, Infosys ROCE approximately 35 to 45%, TCS ROCE approximately 50 to 60%. Why? No factories, no inventory, software and human talent require minimal permanent capital. The business model is hire engineers, train them, deploy them on the client projects, bill at the margin. Capital required essentially just receivables and cash for salaries. Next is capital light FMCGs. Hindustan Unilever ROCE over 100%, Nestle India ROCE approximately 90%. How ROCE is over 100% possible? Negative working capital. Distributors pay HUL before they receive the goods. HUL receives cash before it spends on the production. This means HUL receives its supplies and distributors a source of the free capital, reducing the capital employed below zero in some periods. Next, the capital intensive manufacturing. Tata Motors ROCE approximately 8 to 15%, requires factories, R&D, tooling, spare parts, inventory, massive working capital. Not a bad business, but capital requirement limit is ROCE. At the bottom, required utilities, NTPC, ROCE approximately 7 to 9%. Massive capital investment in power plants, returns regulated by the government. ROCE barely covers the cost of the capital, but dividend income and regulatory predictable make them different investment cases. BEL or episode 27 defense company, ROCE approximately 20 to 25%. Good for a manufacturer. The key insight, ROCE companies tend to stay ROCE if the genuine competitive advantages. This is what the Warren Buffett calls the economic moat. Now in our next section 5, the value creation versus value destruction. This is the most intellectual profound section. The EVO concept simplified here. Here is the concept that institutional investors use, but most retail investors have never heard of. Yes, economic value added, the EVA. EVA equals EBIT minus capital charge, which is capital employed multiplied by capital cost. When EVA is positive, the business earns more than the minimum returns required to justify the risk. When EVA is negative, the business destroys value even if it shows accounting profit. Let me show you the real example. The utility company earns 8% ROCE, cost of capital is 11%. Now we shall see on every rupees 100 of the capital employed, it earns rupees 8, but investors required rupees 11. EVA is negative rupees 3 for 100. The company shows accounting profit, it pays dividend. It is not a bankrupt, but it is destroying rupees 3 of value per 100 invested every single year. Now compare Infosys. ROCE 40%, cost of the capital is 11%, EVA is positive rupees 29 per 100 invested. Every year Infosys creates rupees 29 a new wealth per rupees 100 of the capital entrusted to it. This is why Infosys, despite trading near its 52-week low, is structurally a superior business, and this is why the episode 22 DCF assigns it a higher terminal growth rate. High sustained ROCE over the long period is the clearest possible signal of genuine competitive advantage. Live demo of finding and comparing ROCE on screener.in. Go to screener.in. Go to screener.in, type screener.in in web browser. This will screen will open, log in yourself, and this arrive at the desktop of this screener.in. Then click on the search for a company. Here we will search for Infosys first. Infosys, if you click on the Infosys data of Infosys has arrived here, then click on the ratio section here at the top. If you click on the ratio section, you can see the ROCE row here. ROCE row here. Now compare the ROCE for the last 5 years. It is ROCE of Infosys is between 37% and 40%, roughly for the past 5 years. Now in the step 2, we shall see the next IT sector giant TCS, Tata Consultancy Services. Click and select on the Tata Consultancy Services. Go to this ratio section here at the top. Now you can see the ROCE for last 5 years, May 22 to 26. You can see TCS ROCE is 54% and 50, but it is ranging between 54% and 65%. This is better than that of the Infosys. Yes, so the IT companies have TCS has performed very well in the IT company series. Then now we shall see the FMCG sector here. So click on the search screen here. Hindustan Unilever Limited. Hindustan Unilever Limited, we shall see HUL. The statistics have arrived here. Click on the ratio section here at the top. Now you can see the statistics from 22 to 26, last 5 years. It is ranging between 25 and 28% only, very less compared to the IT sector. So Hindustan Unilever has not made much headway in this ROCE. Then we shall go check the NTPC sector, the power sector giant here. Click on the NTPC screen has opened. Click on the ratios here. We shall see it is very less compared to all we have seen so far. It is between 9 and 11% only NTPC. It's very less. Next, the step number 7, key insight. Use screener.in. Compare the features always. Look for ROCE trend for the 5 years consistently. High and stable ROCE over the 5 years is more reliable than a single year itself. Now, in the next step, applying to Infosys results on July 23rd. After Infosys announces results, find the Q1 27 results. EBIT to Infosys results, Q1 27 EBIT results, capital employed in the press release, calculate ROCE manually, holding, you have to check whether the holding is above 35%, business quality intact despite the macro headwinds, appraise yourself and get satisfied about the Infosys results. Like this, you have to see and check this and know yourself about the ROCE of the various companies before making any investment decisions. Section 7, how ROCE changes your investing decisions. Connect ROCE to every prior episode. The complete close. ROCE changes 3 specific decisions in your investing process. Decision number 1, stock selection. From episode 22 DCF, use ROCE to determine whether the company deserves high or low discount rate. Then, companies with ROCE consistently above 25% over 10 years have a proven competitive advantage. Those advantages lower the risk of your DCF assumptions. Use lower discount rate. Then decision number 2, portfolio construction. From episode 24, preference for high ROCE companies within each sector category. In your 15 to 20 stock portfolio among IT options, prefer a higher ROCE company, other things being equal. Then the decision number 3, sector comparison. From episode 19, when you rotate between sectors, ROCE tells you which sector structurally create more value. IT and FMCG structurally create more value than utilities and commodity business. This is not a timing call, it is a quality preference. Before Infosys announced results on July 23rd, ask yourself not just what the revenue will be, but is Infosys maintaining the structural ROCE advantage above 35%? If yes, guidance, upgrade or miss is a short-term event against the long-term structurally superior business. If ROCE is declining, investigate why. Has the business model changed? Comment below which company of your portfolio has the highest ROCE right now. Check it on the screener.in. I reply to every day Infosys results tomorrow. Episode 28 gives you the ROCE lens and read them correctly. Please subscribe, like, share with your family and friends, and support me for bringing more such good videos for you. And thanks for watching.